What is this slight uptick? What does this mean, not only for the economy, but for the Fed? Again, their meeting coming up at the end of this month.
Well, given the trend for inflation has been going down, I think the Fed is going to take it in stride and say, look, we are closing in on our 2% target, and it's time to start to lower rates. I think Chair Powell said that if it weren't for the tariff uncertainty, he'd be doing it now. So I'm also in that same camp. It's time to lower rates. The real rates are way too high, and they're restraining the economy.
All right, so you think rates are higher. Very quickly, we're going to just kind of show the path of CPI, both core and headline. And I mean, it's certainly declined. We're showing it right now. But the fact that we're going to start to see, or we're expected to start to see, the uptick of inflation due to tariffs, do you still think that the Fed is going to go that way, especially with these new tariffs announced, possibly starting on August 1st?
Well, to the extent that tariffs do take hold and they raise prices temporarily, I think the maximum they're going to raise prices is negligible. The downward trend, especially behind the tariffs, is continuing. Chair Powell knows that. The Fed staff knows that. All the forecasts know that if we do have a price effect from tariffs, it's going to be a one-time jump, and then it'll be over with. But I think one of the things to remember is that the U.S. is a closed economy. 70% of our consumer basket is services. 30% is goods. Of the 30%, only 25% come from imports. You work out those numbers, and even a 20% jump in tariff will only raise prices by less than a percentage point.
All right, so you see a minimal impact due to tariffs, even with the new ones that are announced.
Right.
For the Fed, also, job market stability is part of their dual mandate. We have seen some weakness in the job market. We've seen an uptick, and specifically when it comes to certain areas of the job market, even more weakness and a lot of announced layoffs and things like that. How does the Fed view that?
That's a very important point. The Fed, I think, is very cautious about not allowing the weakness in the labor market to translate to unemployment. The one thing that President Trump wants and everybody in the Fed wants is to maintain the 4 to 4.5% range in unemployment rate, which is the equilibrium rate for the U.S. economy. And now the private sector seems to be slowing down in its hiring. It hasn't laid off anybody yet, but these signs of weakness are things that the Fed's going to pay very close attention to. That'll drive the rate decision much more than the inflation problem.
You know, Bill, earlier we were mentioning the 30-year bond hitting its highest level since 2007. Is that something that the Fed pays attention to? The president pressuring Jay Powell about short-term borrowing costs, but does the Fed itself pay attention to the fact that we're looking at the 30-year right now at 4.95?
Absolutely. The long rate is where the interest rates affect the economy, housing and investment decisions. But the Fed is only able to affect the short rate. So I think what the Fed is trying to do is to say, look, we're going to lower rates as according to what's happening to the labor market and what's happening to inflation. But as far as the long rate's concerned, where people really are going to be affected much more, that has to do more with the deficit and how much the U.S. government is crowding out. And insofar as taxes are coming down and expenditures are not, then crowding out is going to be a real prospect that is going to be hurting the U.S. economy more than anything else. And by the way, one other thing, the dollar slide that we've seen since February is also a sign that the fears of uncertainty are out there. But as you say, in the last several days, the dollar really has strengthened quite a bit. And the dollar decline is also adding to the inflation pressure, I think even more so than tariffs.